Well, the US dollar has started to appreciate against other G3 currencies in the last couple of weeks, not just because of rate differentials widening. In fact, rate differential widening in favour of the dollar started in February. But what's happened most recently has been a growing divergence in the growth and the inflation data in the US versus Europe and Japan in particular. And we think that persists for a little while longer. But as you start to go into the second half of this year, Europe's own inflation, assuming oil prices stay where they are, starts to tick up, as does Japanese inflation as well. So cyclically, on a shorter-term basis, we think that this rebound in the dollar is a fairly finite period of time. But secondly as well, you have to go back to the structural factors. Both the goods and services trade deficit in the US and the fiscal deficit are widening. They were widening before tax cuts were introduced, and the tax cuts will exacerbate that widening. So structurally, there's going to be a growing supply of dollars in the system over the next 2 to 3 years. And that potentially creates a further structural headwind for the dollar longer term.
And Mark, that's interesting, of course, because it comes at a time when the U.S. administration is trying to narrow the trade deficit, if you will. We know the comments coming on trade, specifically with China, continue as we await the big visit from the delegation heading to the mainland. What are your expectations on this front? If we don't get a bearing of the hatchet, if you will, could this exacerbate Forex moves as well?
I think so. I think it will exacerbate Forex risks through the impact of risk appetite being affected. So when investors pull back exposure from financial markets, whether it's because of a geopolitical catalyst or an economic catalyst, the dollar normally strengthens in that environment because it's seen as a relative safe haven. So the relationship, the economic relationship between the US and China is especially important at this point in the market cycle, but also given recent currency moves.
And it does have implications for other markets across Asia as well. What is your view, more broadly speaking, of the emerging markets that are most vulnerable to dollar strengthening?
Yeah, I mean, if you look at those markets which are vulnerable to capital flows, have relatively thin foreign currency reserves, those markets tend to come under greatest pressure when the dollar appreciates. So if you look at economies such as Turkey, to some extent Brazil, but perhaps less so than in recent cycles, those are the kind of currencies and those are the kind of markets with high beta that could be affected by an ongoing strengthening of the dollar due to reversal of capital flows and an erosion of relatively thin foreign currency reserves.